Good afternoon, everyone, and thank you for joining us for our latest charity webinar, Managing Financial Uncertainty for Charities Relying on International Aid. I'm Jill Halford, Head of Not-for-Profit at BDO, and it's my pleasure to welcome you to today's webinar. Before we start, I just wanted to confirm that we will be recording the session and we'll circulate the recording and the slides early next week. So if you'd like to share with colleagues that can't make it today, then please do so. We've got an hour for today's session, and I will be saving some time towards the end for you to ask any questions of our guest speakers. So why are we here with you today? Well, since the announcements by the US administration back in January of this year that stated it was pausing and undertaking a review of all overseas aid spending, many UK charities felt the sudden impact of this and significant disruption of loss of funding by US aid and the US State Department. So just for context, the US is the largest aid donor, providing around 20% of all aid by their 32 members of the OECD. And back in March 2025, the Secretary of State said that 82% of all USAID programs would be ending. His department had previously said that the USAID programs to the value of $54 billion would be ending, and 4.4 billion of programs for the US State Department as well. So naturally, UN agencies and the international aid community have raised concerns around the continuity of their work and including the impact on global health as a result of these decisions. Now, the impact of the reduction in US aid levels have been also compounded by decisions from the UK government and other European governments to reduce their commitment to international aid as well. So with global uncertainty and conflicts increasing, the need for aid is only set to rise, while the funding parameters for supporting those in need is sadly declining. It's against this backdrop that charities in the international aid sector find themselves operating in an ever-increasing challenging situation. Today, I'm really pleased that we are here with a number of our specialists, and I will shortly be handing over to our guest speaker from Bates Wells, Suhan Rajkumar, who will talk us through some of the governance and legal considerations to help you manage some of these challenges. I'll then pass over to Matthew Tate and Katie Cooper, two colleagues that I work very closely together with, and they'll be discussing ways that you can build financial resilience. And then we'll start our Q&A. I'll be joined by three other colleagues who I will introduce at that stage from our not-for-profit tax team, value creation services, and international institution and donor assurance team. So please, can I ask, as we're going along, that you use the Q&A function at the bottom of the screen. If you just hover your cursor over that, you will hopefully will pop up, and pop your questions into the Q&A function. I'm sure you're familiar with the functionalities of Zoom. I'll be monitoring those questions that you pose, and I will ask our speakers your question at the appropriate time. If we don't have a chance to get through all of the questions, we will come back to you later with a response to those. So without further ado, I will hand over to Suhan.
Great, thanks so much, Jill, and hi everyone. Really pleased to be here. So just a quick introduction. I'm a partner in the charity team at Bates Wells. We're a specialist non-profit law firm and work mainly with charities and non-profits in the sector. I advise a wide range of international development charities, and we've been seeing the impacts of USAID's cuts, FCDO's cuts, the wider kind of economic situation on charity fundraising, and helping our clients to navigate some of those difficulties. I'm going to speak today about trustee duties and the role of trustees, both in managing charities' financial positions and looking at insolvency and potential insolvency, as well as looking at some more practical tips for charities and finance teams in facing financial difficulties or looking at different financial scenarios thanks to the impact of international politics. Before I do that, I thought I would just touch briefly on some of the other advice that we're giving and some of the things which I know some of you will be considering in light of the wider impacts of US aids, of the changes in US aid and US policy. We're speaking to lots of organizations, US registered organizations, which are looking to establish entities in the UK, either where previously they didn't have an entity in the UK or where they previously operated via branch in the UK rather than a separate entity. I'm also speaking to lots of international federations about how to move funds to the UK, either because there are significant endowments in the US, which may be a threat from the US administration, either directly or via changes in tax policy in the US, or because of a more substantial operational shift from the US to the UK. I won't cover that in much detail in my talk because, as I understand, I think most of the people in the room, the virtual room today, are from UK-based organisations. But please feel free to pose any questions in the chat around some of those issues if that would be helpful for us to cover. So next I'll cover trustee duties, just moving on and to the next slide as well, please. Thank you. So I thought it'd be helpful to talk about the roles of charity trustees as compared to the executive team and how that shifts when a charity, excuse me, is facing some degree of financial difficulty or uncertainty. Obviously, all of you know that a trustee's overriding duty is to advance the purposes of a charity for the public benefit, and the Charity Commission breaks down that overriding duty into 6 fundamental duties set out on the next slide. The Charity Commission sees those 6 trustee duties as ensuring your charity is carrying out its purposes for the public benefit, acting in your charity's best interests, complying with your charity's governing document and the law, ensuring your charity is accountable, managing your charity's resources responsibly, and acting with reasonable care and skill. All of those are relevant, but we'll focus mainly on those last 2, managing your charity's resources responsibly and acting with reasonable care and skill. Moving on to the next slide. There's a lot of text on this slide, so apologies, but I thought it'd be helpful to talk about what those duties mean in practice when it comes to financial management by trustees. It's essential for a trustee body to have a good knowledge and understanding of a charity's finances so that, as far as possible, they can assure the continued viability of the charity and its charitable activities. The trustees are ultimately responsible for the operation of the charity, and although much of the financial management will be delegated to the executive team and the finance team, it's incumbent on the trustees to understand the financial position and monitor it closely. That only becomes more important when there are significant changes in your financial position or possible difficulties on the horizon. That includes understanding the organisation's cash flow, the expected income projections for the rest of the financial year and the following financial years, expenditure and significant expenditure arising, and within all of that, management of restricted funds, which, as you all know, can only be used for the purpose for which they are restricted. There can be cases when solvency can happen suddenly. For example, where charity doesn't have enough reserves, which I'll come on to in a moment, or is wholly dependent on grant income, which is withdrawn at short notice. And we've seen that across the sector following USAID's very sudden cuts. However, in most cases, provided that you have proper financial controls in place, trustees should be able to identify financial risks with the support of the executive team and plan for their management at an early stage, making changes to the charity's operations and budgeting in order to continue operating despite changes in the economic environment. The overall responsibility for effective governance and implementation of proper financial management sits with the trustees. I mentioned reserves, and I think it's not kind of possible to talk about financial management of charities without talking about reserves. The Commission expects that all charities should have a reserves policy, which fully justifies and explains whether or not the charity is keeping reserves, identifies risks in relation to and plans for the maintenance of essential services for the communities you serve, and reflects upon the risks of unplanned closure with the charity's business model. And in setting a level of reserves, assuming you choose to have reserves, helps to address the risks of unplanned closure by setting an appropriate level of reserves. Moving on to the next slide. All of those duties are sharpened and changed slightly when a charity is in financial difficulty. At all times, the trustees are responsible for the financial management of the charity, but the trustees' oversight and involvement becomes particularly important at such time as the charity is facing financial difficulties. Trustees need to ensure that they regularly receive and consider robust and up-to-date financial information and keep the position under review, documenting all decisions and meetings, and possibly even keeping Dear Diary notes if there's serious financial concerns. The trustees should work with the executive team to analyse and review sources of income. The Charity Commission is particularly concerned about the practical risk that dependency on one source of funding can present. And again, we've seen that across the sector with USAID's sudden pause and eventual stop of funding. On the slide here, which I think we'll share, you can see a couple more practical steps, such as reviewing planned and proposed expenditure, reviewing your reserves policy, and taking more immediate action. It's really important to note that the trustees' duties to furthering the interests of the charity switch at the point of insolvency to becoming a primary duty to the charity's creditors instead of the charity's purposes. What does all of this mean in practice for trustees? This is a question we often are often asked, but I won't focus on it too much here. On the next slide, I'll talk very briefly about trustee liability. Trustees can be personally liable for the debts of a charity in certain circumstances. Generally, if you have an incorporated structure, a charitable incorporated organisation, a limited company, the liability of trustees will be limited, except where there's been a breach of trust, an insolvency scenario involving wrongful or fraudulent trading, where the trustees are given personal guarantees or are subject to criminal sanctions, or where the trustees are personally sued, for example, in a discrimination case. Trustees can and generally should get trustee liability insurance, which can help to mitigate some of those costs. The main mitigation for trustees, though, is acting reasonably and taking proper advice. The position is slightly different for unincorporated charities, as trustees don't have liability where there's no incorporated entity. I think that's probably relatively unlikely for most of the people on this call, so I won't focus on that too much. The next question in terms of governance, if you're managing a difficult financial position, is serious incident reporting. And over the next couple of slides, I'll just talk briefly about reporting serious incidents. I'm sure you're all familiar with this, but the serious incident reporting regime is a Charity Commission regime to report incidents which are serious within the context of the charity. The Commission expects you to report any serious incidents or allegations promptly to let the Commission know how you're dealing with it. Serious incident is defined really broadly as an adverse event which results or risks in significant harm to your charity's beneficiaries, staff, volunteers, or other people who come into contact with the charity, loss of your charity's money or assets, or damage to your charity's property or harm to your reputation. The responsibility for reporting serious incidents, again, sits with the trustees, although this can be delegated. Moving on to the next slide and then the next one after that. So what are serious incidents and how could they be relevant when looking at difficult financial positions? Actual or alleged fraud would be a serious incident. Sudden loss of more than 20% of a charity's income, for example, due to the loss of a major donor, is set out in the Charity Commission's guidance as a reportable serious incident. So many charities will have had to navigate whether to report a serious incident when USAID paused funding. Similarly, dramatic changes in governance, such as mass resignation of trustees or the exit of a large number of staff, might also be a serious incident. And generally, I think the Charity Commission suggests that charities should take a cautious approach to reporting serious incidents and report if in doubt. Although this can be pretty administratively burdensome for charities, we think it's a helpful approach because it reduces any risk that the Charity Commission, when you're already in a difficult situation, might add to your problems by accusing you of underreporting or failing to comply with the obligation. For this reason, we think it's generally helpful to report things which might attract a degree of media attention, and that can include, in this context, significant organisational restructures, particularly those which might result in staff redundancies. Moving on to the next slide, I wanted to end just exploring a couple of practical tips, I think some of which colleagues from BDO will go on to dive into in more detail. So I've talked mainly about the duties of trustees and how it's important for trustees to work with the executive team, whether through the whole board or via a finance committee or similar, to monitor the financial position when you're facing financial difficulties or changes in your income. What are the practical steps that trustees can take, trustees and executive teams can take beyond just monitoring the situation? Some of these will be obvious, but I thought it would be helpful to run through them. First, is there any discretionary expenditure that can be cut? Do you have contracts that you can terminate or review, or other programs that you might have to consider restructuring, obviously subject to the application of employment law, particularly in relation to redundancies and engagement with staff unions? If you can't cut expenditure, can you reach agreements to defer payments with key creditors? There's a formal process, for example, for deferring payments to HMRC. Could you consider merger, either in part or in whole? That could be in relation to specific programs where a competitor or another organization in the field is operating a similar program, and you might be able to jointly realize efficiencies by merging that program or agreeing some sort of joint venture. Or even on a larger scale, could there be efficiencies in merging organizationally? Obviously, if looking at a merger, there are many legal considerations, and we recently produced a guide to mergers, which I can share if anyone would like the link. I mentioned very briefly restricted funds, and many charities in the sector will have restricted funds, both from donations, also from previous mergers, both from institutional donations, also from previous mergers, but also from public fundraising, where particularly if you haven't had broad enough wording on your fundraising appeals, you might have restricted funds for specific emergency appeals, where you've asked specifically for funding to cover a particular natural disaster, for example. It's worth looking at whether you can vary the terms of those restricted funds, subject to the application of charity law, which might often involve an application to the Charity Commission to vary the terms of a restricted fund. You might also have designated funds which you've set aside for a particular purpose but aren't restricted in charity law, and you might explore whether you can undesignate those funds, and that can be easier than varying the terms of a restricted fund. If the difficulties you're facing are serious, it's worth considering professional advice at an early stage from insolvency practitioners, accountants, and/or lawyers. At that stage, it's also worth, and I've touched on this already, having regular board meetings, keeping comprehensive minutes, and keeping contemporaneous records of all decisions and the rationales for them, including on the basis of options analysis with clear explanations of the pros and cons of different options and why certain options have been chosen. All of this, of course, should be done while reviewing regular cash flow forecasts to mitigate the risk of a sudden or unexpected insolvency. Covered a lot of ground there, so please do let us know when we get to the Q&A if you have any questions on any of that. But for now, Jill, I think I'll hand back to you. Thank you.
Thank you so much, Suhan. So I think now we're handing over to Matthew and Katie, who are going to talk to us about how do we build that financial resilience.
Thank you very much, Jill, and good afternoon, everyone. My name is Matthew Tate, and I'm a partner at BDO, and I'm also joint head of public sector and not-for-profit restructuring advisory. I thought it would be useful for you in this small section for me to start telling you about what we have currently seen in the market and in the NFP restructuring advisory world. And broadly, that fits into three categories of clients, which I'd just like you to think about. So the first category is charities that have already prepared short, medium and longer term forecasts that identify at a point in time a working capital or operational funding issue that, whilst not immediately impacting their viability, and in restructuring terms, we define viability as a period somewhere around 3 to 6 months horizon. But they have also assessed on a reasonable basis, and that's picking up on one of the words that Suhan used, on a reasonable basis, that there is a probable, i.e. it is real, impact on their longer term sustainability. So that's category one. And we work with those charities to stress test those forecasts and then critically appraise and develop efficiency and operational change programs, which importantly provide support to the governance and therefore duties considerations of the individual trustees. We also undertake options analysis, i.e. what can you do, and that would include new or extended funding, looking at the terms of the institutional debt that might be within the charity itself, for example, covenants, and then creating and working with monitoring dashboards, as well as all of that to go towards monitoring and informing good quality decision making. So that's category one. Category two, these are charities that are very similar to what I've just talked about, but the question of viability is more immediate, i.e. it is within that 3 to 6 month horizon. Such charities have commonly, but not always, seen a gradual decline in their income and have not usually prepared scenario-based analysis and forecasts. There is therefore a need to accelerate the production and testing of those forecasts and models, and then drive cost efficiency programs. And in many cases, if not all, there is a consideration of trustees and directors' duties. So that advice, and this is something which again I think is always important to emphasise, is not just a one-off. It's something that has to be periodically refreshed as the situation develops. Optionality in category two is definitely more restricted, specifically the ability to implement in time initiatives, i.e. in time, but based on an appreciation of the cash runway, specifically to increase income or agree additional funding support. So there is a very significant concentration on the balance sheet and cash flows, and therefore the category and therefore optionality that flows from that depends quite strongly on the balance sheet. There is commonly the challenge of how to fund change programs, for example, redundancy programs, if that becomes necessary, or corporate simplification. Another common feature is advice relating to stakeholder communication, including serious incident reporting, and then just the general communications, both internally and externally. Just commenting on serious incident reporting, we certainly advocate early reporting, but noting that the Charity Commission's guidance is that if we go into the form that they provide for you to do that, it does say provide a summary. And we think it's sensible to provide a genuine summary of the position and then, as necessary, update it so that you've always got a marker in place that you have already reported it. In a number of these types of engagements, we work with our M&A colleagues to understand the potential should it be needed for merger, but it's not actually that common that it actually proceeds. But that goes and aligns to trustees' duties, which is to take all reasonable steps to ensure that should the creditor duty become engaged, that is one of the steps that would go to protect the interests of creditors. The third category, the unhappy category, is charities who face an imminent and therefore existential threat. Straightforwardly, that's a question of solvency, and therefore legal advice is definitely foremost. In most, if not all of these cases, there has either been a lack of detailed forecasting or a lack of challenge to those forecasts by the trustees, and quite clearly that is a duties matter. That would indicate to us, and therefore we would be working with the charity in question, a question relating to whether there is an optimal relationship between the charity's trustees and the executive itself. That also is underpinned, we're commonly seen, by an institutional morale issue. Again, we have to work with that. Picking up on Suhan's point, the change of duties so it's a switch from the trustees' duties to promote the objectives of the charity, and that can switch to what's called the creditor duty. I don't want to in any way underplay how big an issue that is, because it's very much out with the normal experience of a charity's operations. And we know from relatively recent experience that executive management teams can really struggle with that change of duties, and that does cause friction between the executive management of a charity and its trustees. It really is a significant shock. So our work therefore focuses on cash and cash preservations in order to extend the runway, contingency planning, i.e. the what if questions, which are quite real, and that would include accelerated merger analysis. So that's working with different part of our team, which is special situations merger and acquisition team, who are specialised in operating M&A activities at great pace. If the balance sheet is strong, we also look at solvent liquidation as a potential option. But also, again, the funding that is needed to get there, noting that the funding environment is extremely challenging. Thankfully, we found that the charities in the international funded category that we've worked with have all been in the first or second category. Now, that's hindsight that tells us that. Obviously, the volatile decision-making, that's a slightly euphemistic phrase, from the US administration led to a number to being very, very concerned that they might fall into category 3. Through no fault of their own, not least because the expenses of long-term programs are commonly partially or wholly lagged funded or on a reimbursement basis. The single biggest common thread that I can identify across all of those categories is the degree to which demonstrably there is a good or effective relationship between the executive management and the trustees. There has to be an appropriate balancing of the support that's needed between the two, particularly the executive management teams from the trustees, whether they genuinely believe on the shared objectives and they are clear what the objective is, and that could be preservation. Innovative thinking, nothing is off the table. We need to think very widely. Challenge, the trustees have to demonstrate challenge. And this is a matter that we would commonly find as a weakness in some of the minutes, is that whilst the minutes might record decision making and indeed things like attendance, subject matter, areas of concern, but it doesn't record challenge. If you wish to see comments relating to that, we've recently assisted in the report on University of Dundee and the investigation, which is also a Scottish registered charity, and one of our comments there is that there is insufficient evidence of challenge by the effective trustees of that organisation. The other thing is to recognising, particularly in that category 3, is the degree of commitment. It bleeds into category 2 too. What I mean by commitment is just the sheer amount of work that is needed in order to recover. So over the next few minutes or so, my colleague Katie will be taking you through some of our other views and our observations based in that recent experience of the practices that we see in that basically work to build resilience. And to kind of summarize what we want to get for you out of this session, firstly is to have a serious and informed conversation as to how you understand, challenge, track, and forecast your financial position. We do see quite a lot of variance in that, and a good, robust conversation, whilst it might be uncomfortable, is certainly one that is ultimately going to be valuable if the hindsight principle is not going to come back and bite you. Hopefully I've conveyed that point at which you need to recognise that your need for reliable baseline information so as to inform an urgent decision mustn't be after the point at which you actually need it. So in other words, that's post-fact. Secondly, is to say that the investment of resources, and this is always a challenging decision for trustees to say we have limited resources and therefore why should we be spending this money? But the investment of resources, money, time and thought, so not just the cash element of it, on a true assessment and robust challenge of that risk at the costs and the benefits is worth it and repays over a very long period, where the output in particular is properly and flexibly designed. In other words, it can be made to fit other scenarios. The formulation of an appropriate financial forecast model can be complex and requires skill and experience, which is invariably in-house, but the process of its creation gives great insight to management teams and can itself be the catalyst for positive change. So it is not just a forecast which is underpinning, for example, trustees' duties. It's also a catalyst for change within the organisation. We've seen a lot of that from our clients. As more significantly, specifically for the not-for-profit sector, the approach we advocate improves communications with the Board of Trustees and promotes better relationships and decision making. We have on a couple of occasions found that there were certain no-go areas of conversation between trustees and executive management, and actually the catalyst of preparing the financial forecast gets that out into the air and ultimately resolves them. So like non-charity corporates, charities have already mentioned, have a broad duty to understand the financial position of their entity, in particular whether the entity is a going concern, and more specifically in insolvency terms, whether it is solvent or not. But charities are in a slightly unusual position, which is that they have more of a duty to avoid that insolvency. That's not within the Companies Act. It's not a duty specifically of a director. So it's worth reflecting that over the past 6 months since the US administration, 5 months, US administration announced seismic policy changes to its funding of international aid, and the financial alarm levels have been ringing very loudly. But it's not unsurprising that we've had a lot of activity in the sector. I'm going to pass over to Katie now. He's just going to take you through a bit more of that detail.
Thanks, Matthew. So good afternoon, everybody. My name is Katie Cooper. I'm a director in our public sector and not-for-profit restructuring advisory team. And today I'm sort of going to be following on with the themes of looking at the importance of knowing and assessing your options and some of the more specific considerations for the international aid sector. As Matthew spoke about, it is really key to understand where you are to be able to determine where you're going and what options may be available. Good governance and knowing where you are relies on really quality sort of financial management information that should really be tailored to your individual entity. It needs to reflect your own operations and core purpose, be understandable and pertinent to its audience, and use, as it's been mentioned before, sort of dashboards and KPIs to actively monitor those key risks and opportunities. In an environment of finite and reducing resources, there's always going to be difficult choices to be made, and this naturally gives rise to the essential interplay between financial constraints and delivering strategic goals, and it's vital that these can be modelled through your forecasts. So essentially, forecasting can be seen as two sides of the track. So for downside planning and statutory risk management, and then just using it as that opportunity to look at operational and financial efficiency to build sort of new ways of working into the organisation. Essentially, forecasting helps you know and assess your options. So turning to platform 1, we don't always see this, but forecasts should be integrated. That means the 3 primary statements, the SOFA, balance sheet and cash flow, should all link together and be built with formula-driven, flexible assumptions. There can be a tendency in the charity sector to focus on the SOFA and the net surplus or deficit position. And whilst, of course, the bottom line is important, the value of having a model that properly flows through the assets, liabilities and reserves position of an entity and working capital and cash requirement on a monthly basis really cannot be overemphasized to help you build in financial resilience, especially when unexpected events occur. So your key drivers and risks will be specific to your entity, but it's helpful to distinguish between the more operational issues that are known and whose impact can be quantified, and those that are more unpredictable or far-fetched but could have a significant impact. Because by assessing those downside risks, you can then determine the appropriate sensitivities and model possible scenarios, which from those you can then develop your contingency plans to address potential issues or seize opportunities. I mean, we all know that no one has a crystal ball, but a scenario planning approach really helps to test the underlying resilience of the organisation and build a picture of where it's heading to help ensure the long-term viability and sustainability. And even though there are things we know we don't know, it's important to try and capture those in the scenario plan so that the range of outcomes can be modelled and mitigating actions assessed. And while as for the unknown unknowns, well, at least with a fully functioning integrated forecast, you have a head start in your ability to model the impacts as soon as they rear their usually ugly heads. So really the key takeaway is that the forecast should be an active management tool that incorporates and monitors sort of the KPIs, tests the covenants and other key metrics that are important for you. You know, the longer the runway for considering a problem, the greater the options for taking sufficient mitigating actions, as Matthew said, between our three different categories of clients that we see. So it's also a well-known saying that cash is king. So understanding your cash position now and in the short and medium term is essential for financial resilience. For a lot of clients we speak to, we recommend they use a short-term weekly cash flow that tracks the planned inflows and outflows with a minimum period of 13 weeks. This is often key to identifying intra-month working capital requirements and cash pinch points that require appropriate management. So turning to platform 2, Matthew's mentioned that, you know, sort of completing or updating the forecast is a great opportunity to look closely at the way you work and improve your financial efficiency. You know, taking that time to really gain a deep understanding of income, costs, working capital and operational processes provides that sound basis for decision making. So some of the questions you could maybe ask yourselves are, you know, how secure are our existing income streams and what is our ability to find adequate alternative sources? Do we need to right size our aims and objectives to be able to manage within new funding parameters? How are assets being utilised? Is this the most effective use to further our charitable objectives? Have we reviewed our contractual commitments? Are these obligations manageable now and for the remaining term? Is our investment structure optimal and best aligned for access to working capital if required? And have we benchmarked our employment costs or other key costs against best practice? Essentially, there needs to be a focus on demonstrating value. So moving on, we've kind of pulled out some of the more specific sector considerations for charities relying on international funding. You know, our clients have seen a trend towards higher levels of their funding being restricted, with the ability to secure unrestricted funding more elusive. And this has put a general pressure on the level of income available and makes specific forecasting of restricted project income and expenditure and general costs even more important. Consequently, it is essential that charities properly understand the funding contracts that they are signing up to and the conditions attached to expenditure that can be recovered. You need to ensure that reporting is done correctly to maximise that recovery. Cost recovery rates on grant funders vary, so a change in funder can have a significant impact. From clients we've worked with, their US-related grants tended to have a higher recovery rate, and so the reduction in those contracts has led to more significant impact on right-sizing operational costs for the remaining entity. For the purposes of modelling, special attention should be given to cost allocations between departments, branches and subsidiaries to ensure that they are transparent and proportionate, so that performance data upon which decisions are made is sound. Suhan has also mentioned that special attention should be given to making sure that you're reflecting your restricted reserves appropriately so that the true unrestricted position is clear and not overstated, and to consider, you know, whether there is any sort of designated or restricted reserves that might be available to be released. Essentially, sort of now is the time to do all those jobs that you've sort of pushed down the road. Some examples we've seen are ensuring that you've properly understood and recorded employment status of staff. So who is a contractor, who is an employee, what legal jurisdiction do they sit within, what advice would be required if we needed to make redundancies. It's really important to have these facts easily at hand, as they will have an impact on the processes that need to be followed and the costs incurred if a restructure is required. Another common area or issue we see is the corporate structure. So does your organisation have branches based internationally, or are they subsidiaries, i.e. separate legal entities? So why does this make a difference? Well, if an entity has a separate legal entity, it will be subject to the restructuring regulations of that jurisdiction, which may well be different to the UK. So these need to be considered and planned for. We kind of need to be really clear as well on who the directors of those subsidiaries are and where the responsibility and liability lies. You know, are they the same as your main trustees or different members? And then a branch is part of the UK entity, and so responsibility for that branch remains with the UK trustees. And often we see issues with potential lack of financial controls or delays in reporting that make decision making more challenging and potentially heightened risk exposure for the trustees. So for some larger charities or those with more amalgamations in their history, we're seeing opportunities for them to reduce and simplify their structures to enable cost savings. So corporate simplification might be an area that you wish to consider. Suhan again has also touched on your free reserves policy, and I think the only other comments we'd add is that it's just checking really that those level of free reserves are in line with your risk policy, and that you can manage your working capital requirements within those, and flexing them for the different scenarios that you run on your forecast. It's really important to have those red lines established so that these can be monitored and assessed. Recording decisions and actions and your board minutes is the best defence, as others have touched on. Mergers and consolidation in the sector are expected to increase as there is a move to drive cost efficiencies to deliver maximum value of funding. There are many positive aspects to a merger, and doing background proprietary work to understand who may be suitable partners in terms of objects, operational aspects, cultural fit, etc., would be a good investment in time. So thank you for your time today. I'm going to hand back to Jill now for our Q&A panel session.
Thank you so much, Katie, Matthew and Suhan. The content of today really, really resonated with me, not just because I'm a charity auditor by day, but in a number of our trustee roles that I hold. I was a treasurer of a small charity that did face financial distress due to a cut in government funding a number of years ago, and a number of what we've talked about today, I had to put very quickly into practice. And I think the key benefit for me was really pulling in legal support and importantly, professional insolvency support. And pleased to say that organisation is still going strong after those that bump in the road. So I would love to invite Ross McWeir from our Value Creations department, Helen Berry from our not-for-profit tax team, and Lisa Olufemi from our international institution and donor assurance team to join us with Katie, Matthew and Suhan for our Q&A session, please. So if you could pop your cameras on, just so everyone can see you. We will circulate the slides, as we said, so you will have everyone's details after the event, but maybe if we can take down that slide, if that's okay, and then we can see everyone's smiling faces. We have had a couple of questions from our participants. Just a quick one for Matthew first up, if that's okay. Matthew, could you quickly remind us of the names of the 3 groups of clients that you mentioned at the start of your presentation, please?
Yeah, of course, and hopefully to help the audience, I'll give them titles. So category 1, which is those who have a sustainability, so they are the sustainability category, so they have issues that they're identifying through forecasting beyond the period of 6 months. That's category 1, sustainability. The second one is viability. So there's a much more immediate issue. There's still time before what we call the control watershed comes into focus, and we'll call that the viability category. And then we have the final category, category 3, which is distress. Either there's a full-blown distress, directors' duties, trustees' duties are to the foremost. So those are the 3 categories.
Really helpful. Thanks for the recap, Matthew. Question for Suhan. Is the serious incident reporting only for incidents in the UK, or does it extend to the full group?
Thank you. So that goes partly to Katie's explanation of how group structures might work. Certainly it would cover any branch entities which are part of the UK entity, where staff are employed by the UK entity even though they're in country. Whether it would cover the wider group will depend on your group structure in part and the nature of the event. The Commission, in its serious incident reporting guidance, actually links to a specific guide on reporting incidents relating to partners. And broadly, it says that you should report any incidents which relate to your charity's money. So if you're funding a partner organisation, other resources of your charity, for example, your charity's staff, if they're seconded to one of the federation, or your charity's brand name. And so often group incidents or allegations will be reportable by your charity. Again, generally, I think it's worth taking a relatively cautious approach, I think. So that would mean, for example, you wouldn't necessarily need to report financial difficulties with a group entity, but if a group entity was doing something which might attract adverse media attention, so dramatic sudden closures of programmatic work or sudden redundancies, then you might consider reporting that.
Thank you, Suhan. And my experience of all of the regulators, all the charity regulators, is if there's any doubt, then please report. They'd rather know rather than seeing it in the press retrospectively. Maybe a question for Ross, and maybe Matthew, you may want to come in. How are your clients increasing their cost recovery?
It's a great question. I think really it links back to flexibility and building in flexibility to the operational model. What I've seen with a couple of clients is making sure that they've got flexible teams that can pivot to different delivery needs, and building that in really helps. That's probably the main thing I'd point to. Thank
you. Matthew, anything else that you've seen as you've been working with organisations recently?
Do you want to reframe the question for me? Is this a question about operational changes? Is this about essentially cost savings programs?
I think it was more around how do you increase that cost recovery from the funding that you're getting?
Yeah, so on one specific matter, which involved legal advice, is to understand the contracts that you have in play, really understanding what those are. Early negotiation to see whether those can be varied or tempered in some way to get accelerated receipt is something which would be, in that particular case, was extremely worthwhile. I think with another couple of charities, if we just go a little bit off track and just look at the funding lines, one of the things I mentioned in my small section was about innovative thinking. And I think we're particularly in category 2 and category 3, because timescales are quite contracted, actually that room to think, how do we make this business as usual again? So Bauer. That sometimes get lost, which is why you don't want to be in category 3, you want to be in category 2, so you've still got that time to have innovative thinking. Beyond the kind of contractual review, but the better ideas that we've seen is, properly looking at what their business model is, what are their funding lines, are there any changes, are there any partnerships that they can enter into in order to accelerate or indeed improve their prospects of recovery.
Super, thank you. And my charity, where I sit on the board at the moment, have done exactly that and really got underneath the detail of kind of every contract that we have kind of coming in, and funding specific projects, but also the core costs as well. And they've developed this, well, slightly biased, but excellent model to really understand the kind of full cost recovery of the organisation, which is really helping us as we're bidding for new work to articulate clearly to the funders, and build in that kind of full cost delivery model, because it can be, as we all know, incredibly expensive to service a lot of projects. And I know a number of organisations that I work with and sit on the board of have struggled to get that full cost recovery percentage up in the past. So really understanding kind of what your contracts and the detail of those contracts, but also the core costs, I think is really key. Sorry, Matthew, coming back to you. What does good challenge look like in those minutes?
I think during my little section, I mentioned the comments that we made at the University of Dundee. It's very common in board minutes to essentially to be kind of rote. So they just have set agenda items, and it just as a paper is presented. It's not as common as I would like to see different views, particularly with different experiences, actually recorded in those minutes. I think there are two reasons for that. One is there's the hindsight principle. So you don't want to be caught out with someone in hindsight saying evidence how you challenge something. That's it's good to have it recorded contemporaneously. The second is that by raising that challenge and having it recorded, so therefore it's also reviewed at the next meeting, noting that meetings don't always have the same attendees, is that kind of challenge tends to spark the confidence in other trustees to raise other more difficult issues or other elements of challenge. So I think it is that freedom, that confidence, the trustee's job as we say in restructuring, is both an objective and a subjective test. So the two tests that we apply is, one is, are you performing your duties in accordance with what the man in the Clapham omnibus would assume that you have got, and the second one is, you're something like a chartered accountant or a lawyer, etc. Are you bringing those specific skills to your role? We would want to see that challenged deliberately and specifically evidenced within the meetings, which I think goes against actually quite a lot of the way the minutes are produced, particularly when you go from a kind of static business as usual state to a challenging state. So have the confidence to change how you then develop your minutes. Don't be hidebound by how you used to do it in the past. Recognise there's a need and make that change.
Great advice. Thank you, Matthew. A question for Lisa. Lisa, you work with a lot of overseas aid organisations and also funders. What do you see are the top 3 pitfalls that charities should be alert to when implementing grant funding?
Yeah, thank you, Jill. Yeah, thinking about this, I suppose, in terms of root causes, and I think we've touched on this a few times already in this presentation. I think firstly is not knowing the specific requirements of any grant funding that you receive. So I can't emphasize enough how important it is to make sure you're reading kind of any contracts around that and not just making assumptions, because different donors will have different requirements. And key to that is involving finance leads then in actually programming those projects, and also then reviewing any contracts before they are signed. Another pitfall where organisations often come unstuck is if they're not getting amendments formally documented, or if they've made assumptions and sought clarifications on those, but maybe spoken verbally with the donor, actually getting that back in writing so that you've got something there to say, this is what we've agreed and this is how we're going to do it. But actually being really careful, some of those you will then need a formal amendment to your grant agreement to do that. So often an email won't suffice. So just kind of clarify that. And I think, again, keeping finance leads involved throughout that programming process is really important, and not just kind of leaving everything to the program teams to organise. And then thirdly, I think one of the biggest kind of risks that we see in terms of grant funding that we look at in international institutions and donor assurance department is where an organisation has worked with a downstream partner. So then they're passing on part of that funding to another organisation. And it's so important for the main recipient, for that main organisation signing the grant contract, to remember that they are actually ultimately responsible for all of that money, even if some of it is implemented by a downstream partner. So some mitigating actions to take on making sure you're conducting due diligence on any organisations that you plan to work with, and documenting that process as well. Having regular check-ins with that organisation, making sure that downstream partners are aware of the donor requirements as well, so that they can also adhere to those. And then also when those partners are reporting back to you, making sure that you're reviewing what they're reporting to you and not just doing a copy and paste into your own report, but you're aware of what they're reporting and that is actually in line with the grant agreement. And feel free to question that with your downstream partners as well before you report back to your donors, and that will all kind of help ensure that you're kind of mitigating any needs for the donor then to recover costs at a later stage.
It's really helpful. Thank you, Lisa. Putting my auditor hat on, I think
Yes,
we often come across grant agreements which are partially signed, never mind the amendments not being legal. So I think I know, especially for multi-year contracts, that can be very difficult to get the funder to kind of re-sign and agree. So I absolutely appreciate that. Thank you. Helen, a quick question for you. What should charities be thinking about from a tax perspective when they're looking to alternative funding sources and also diversification?
Thanks, Jill. I think it's important to highlight there's no carte blanche exemption for charities from a corporation tax perspective, albeit they do benefit from a number of exemptions for corporation tax purposes. So when they're looking at alternative funding sources and possible diversification, it comes back to something that I think Matt said earlier about looking at the contractual arrangements and understanding what that funding entails and any requirements around it. And also, are you looking at diversification and ensuring that that diversification is covered by the objectives of the charity? Often we find there's a little bit of creep and it's just necessary to go back to those charitable objectives. They may need tweaking themselves to ensure that they are aligned to that diversification. And also, I think it comes back to something Lisa just said then as well about the downstream partners. So where you're passing funding on, it's really important to monitor that to make sure that those funds are being spent on your charitable activities as well. So a lot of important considerations. Always look at them in advance before signing and discuss them with both legal and tax advisors as well, to ensure that you don't find yourself coming unstuck further down the line and having to pay out to HMRC.
Thank you. Some great words of caution there, Helen. Thank you so much. We've probably got chance for maybe one more question. Oh, I've just had another one come in, so see if we can answer both of these. So maybe if I come to Katie on this this next one, should all good forecasting models include some scenario planning for merger? Good governance suggests that board should have this on the agenda at least annually to consider whether improved impact could be delivered through partnership or merger.
Yeah, I think that the short answer is yes. So yeah, so when you're looking at your different sort of scenarios, it's useful to look at sort of the positive options that might come from growth or from diversification, which is sort of Helen's just touched on, as well as the downside kind of risks that might be coming from reductions in funding and other areas. And then it is a question of looking at different structural options. So whether a merger is a suitable sort of way forward, or a partnership or a joint venture agreement, it's really sensible to just to have that broad range of options, so that you have quite a few different scenarios as your arsenal, essentially, to understand the best direction for your charity to go in.
Super. Thank you, Katie.
Jill, is it all right if I come in there as well?
Absolutely, Ross, please do.
I think the benefit of where we've seen charity mergers in the past as well, the reason it helps to kind of target it proactively is because the pool of potential merger parties is quite small. It will really depend on kind of the charitable aims. And what we tend to find is, as I say, that the pool is so small that approaching it proactively and with a good amount of time can really help improve that resilience if it does need to happen. So I absolutely love the question. I think it's one that should definitely be on proactive trustee agendas.
Yeah, I totally agree, Ross. I think the sector, in my experience, has been really good at partnership, and we haven't seen so much activity on the merger side. Noting what Katie said, is we do expect that to increase as others are actively kind of pursuing that. One final question before I wrap up. I'm going to come to Matthew. Matthew, what's the typical number of months of core costs, the reserve level, that you would recommend as a trigger point? So what's the red line? Oh, you're on mute, Matthew.
Mute. Yeah, there you go. I've also had to change room because I had a battery outage. So apologies for that. Sorry, again, the question. Sorry,
what's the red line from a reserves point of view? So what's the typical minimum number of months of core costs that you should have in your reserve?
Oh, okay. Yeah, I mean, so obviously depends on, sometimes there are a number of factors into it, but I think I've sort of already mentioned it, which is when you get into category 2, viability, 3 to 6 months. Yeah. So it depends, any reserves policies that for personally, if as a restructuring professional, if I've got 3 to 6 months of reserves, operational reserves, for me to do the work and support as we need to, that is most probably an appropriate policy.
Super. Thank you so much. So I am conscious of time. I hope that has been helpful to all of our participants. Thank you so much for joining. And we will be issuing feedback forms, and your feedback is really valuable to us. Thanks for all of your questions. Hope we've managed to answer all of those. Huge thanks to our speakers, especially to Suhan for joining us from Bates Wells, and to Hannah and Aaron for organising the session today. I hope that I will see a number of you on Thursday at the Charity Finance Conference. We will have an exhibit there, and also a couple of guest speakers as well from our People Advisory team, who will be presenting alongside the charity scope around high-performing teams. It's usually a great event, CFG's conference, so we do hope to see many of you there. Please come and say hi as we're on the stand. As I said, we will be issuing the recording of the webinar, and all of our previous webinars are recorded and on our YouTube channel, and we'll send a link to that as well, so you have that. There's also a QR code for you to subscribe to future invitations. But thank you so much for everyone for participating in today's session, and I hope you all have a lovely rest of the day. Thank you.